The Juneteenth holiday is about freedom. How would you feel when you achieved economic freedom? In the spirit of Juneteenth, highestpaid.online is having a sale on their core options trading course. The name of the course is the highest paid part-time job in the world core options course. With the course purchase, you have lifetime access to the content, 2 live online meetups a month, and 1 hour of one-on-one consulting. This course has helped people get their economic freedom, and it can help you get yours. With this sale, you get 35% off the course price. Use code JUNE35 to access the sale. This sale will end on June 30, 2024. If you miss this opportunity, you may miss your opportunity to get free. Go to thehighestpaid.online and get started today.
What's going on? This is David W. Williams, also known as Diamond Dave. And so what we're going to talk about really quickly is how to view implied volatility like a market maker, right? And so not knowing this about implied volatility can kill your account. This is going to be a really good video for options traders who want to try to understand how implied volatility and how the market makers set and use implied volatility to benefit them, right, can go against you as an options trader. And this is the kind of stuff majority of people don't really understand. And so we're going to talk about a lot of situations that options traders can find themselves in and really don't understand what happens. And as a result, they don't get the returns that they desire, or it starts to erode their account when these particular situations go against them. And it's because at the beginning, at the onset, they didn't really realize how dangerous the situation was, right? So what we're going to do is we're going to kind of break down things in a case-by-case and scenario basis. And once you understand this, you can start applying this to your options trades. And it's going to put you in a position to be profitable as opposed to putting you in a position where you just lose money. So let's go ahead and get into it. So when you get ready to buy an options contract, a lot of times emotionally you're hyped up, you're enthusiastic, you're euphoric, because you really believe you're getting ready to make some money, right? Because you bought the contract from the belief that you're going to be able to turn around in the market and sell this at a profit. And that's your real desire because you're thinking about what are the results that I can get from successfully selling that contract is really what you want. So the options market is essentially a vehicle. So this is your emotion. Now, for a lot of us is when the contract goes against us and things don't go the way we desire, this is how we feel. We're very upset. We're very mad, right? Because the way the setup looked or the way it presented, we thought it was going to be a good situation, and then it turned against us. And it's not that the market did something wrong. Many of us really don't understand the environment that we're operating in. So a lot of times we can be doing well and we don't really know why we're doing well. So then therefore, when things go against us, we don't know how to diagnose it and fix it. So let's go ahead and get into it. So here's some of the things that kill options contracts, right? From a volatility standpoint. It's horizontal movement kills the premium as you approach expiration date, right? And the expiration date starts to combine with theta decay. So you're getting horizontal movement that's killing the premium because you're getting closer to the expiration date. So now theta decay is killing the contract. The expected movement does not happen and it kills your premium. And this is really important around binary events. What I mean by binary events like earnings. So earnings is considered a binary event, right? And so what they do is they set an expected movement and that doesn't happen. And then what it does, it starts to erode your premium. You enter with implied volatility too high. However, you don't know that. So many people are buying contracts, and I made this mistake a lot, and I still sometimes make this mistake, where you enter with volatility, implied volatility too high. And because it's too high, right, essentially, even though delta may look good, the whole situation is very much stacked against you. So yes, we're playing the game of probability, but it's very unlikely things are going to go the way you desire because volatility really is too high. We're going to talk about that a little bit more in depth. And you don't understand, and you never understood how to view implied volatility like a market maker. So you have to understand, how is a person that's making the contract and creating the volatility predictions, how are they thinking? Because they're not your friend. They're not creating contracts because they're trying to do something good for you. They're trying to create a market in which they profit. That's their job. They don't create these markets so they can lose money. They create a market so they can profit. Same thing if you go to Vegas. If you go to Vegas The job of Vegas is for them to make money. It's not for the gambler to make money. They want the gambler to enjoy themselves enough where they come back. But the goal of Vegas is for the casinos to make money. That's why Vegas has sustainability. So let's go ahead and break these down point by point. So horizontal movement kills the premium as you approach the expiration date. So here's an example of Kodak, right? And so I bought put contracts on Kodak after we had that really crazy upswing in their share price up from $2. And what happened was I anticipated the fall off of the share price to be faster than what actually took place. So if you're looking at the dates, 8/10, and we're starting to see a decline, right? But it's not a rapid decline. It's a really slow, gradual decline. So from 8/10 to 8/12, look at the decline. I'm sorry, from 8/10 to 8/11, look at the decline. Then from 8/11 to 8/12, look at the decline. Then from 8/12 to 8/13, look at the decline. It's very, very gradual. From 8/13 to 8/14, look at the decline, right? Then from 8/14 to 8/17, look at the decline. Then you see on 8/18, it popped back up, went back down, and on 8/19, you're starting to see a very gradual decline right now. And so what you see is that because it's pretty much trading horizontal, it's killing the premium. Because what you want in this scenario, right, you want a really rapid decline. So I was under the impression when I bought these contracts, I think the share price was around $30. I thought it was going to be at around $7 to $8 within 7 days. So I bought contracts on Thursday and Friday, and I figured by that next week, it'll be around $7 to $8. And based on the volatility forecast when I bought it, because of the volatility was at a certain percentage, I needed a really, really rapid decline in the contract to really make the premiums go up real high. Once this thing started essentially day trading, it put me in a position to where I was able to get profit on the contracts, but not what I anticipated, because I assumed that this would go down as fast as it went up, and it didn't. The decline in Kodak was very, very, very slow. And we're seeing even now, it closed at, I think we're at 9/12/2020, and it's 640. So we're seeing a very, very, almost not 100% horizontal, right? But a very a gradual decline. And that doesn't help you as an options trader. We want volatility in the direction that we desire, right? What doesn't help us is gradual stuff, right? We want volatility in the direction that we desire. So we believe it's going to go up. We want volatility going up. That's what really boosts the premium on our contracts. If we believe it's going to be a decline, we want volatility going down. So this was a bad situation. So even though I profited it, I didn't get as much as I thought I could have gotten because I wasn't able to get that rapid decline. So the fact that the volatility was high, I paid a lot of money to get in the door, right? And I didn't make as much as I desired on the way out. Let's get into the next example. Expected movement does not happen and it kills your premium. So we're going to talk about that, but also binary events, what we call earnings, right? So we look at Peloton, right? So Peloton, I believe, reported on the close on 9/10. So if we look at Peloton from 9/8, what do we see? It goes up 9/9. It increases a little bit, right? So from 9/9 to 9/10, you saw a gradual increase, right? Then from 9/10 to 9/11, right before they reported, we saw a decline. They reported overnight they reported in the evening or aftermarket 9/10, and it gapped up in the open. And then what did it do? Started to decline. So if you had options that expired at the end of the week or the week after, right, at $90, at $92 or $95, if you didn't sell immediately at the open, your contracts immediately start to lose value, because this is what happens. What's what the market makers do. When you have an earnings date, what they do usually the day before earnings is they set an expected move, right? And what they mean is that after reports, they expect the price point to move in a certain direction. Then what a lot of times they'll do is they will adjust volatility forecasts based on that expected move. So then when the stock opens up the next day after earnings, if you don't start to see that move, right, the closer your contracts are to expiration, the more they start to lose premium, right? So if your contracts go out for Peloton maybe 3 to 4 weeks, the premium decline may not be that great. But if your contracts are expiring at the end of that week, you started seeing a massive loss in premium because what happened? You didn't get the expected move, which therefore you didn't hit the volatility forecast because volatility forecast is based on the movement, right? And that's how they determine the price of the particular security. You didn't get that movement. So what happens now is you start losing premium. So this is why a lot of people advise don't ever hold after earnings. Because once they set that adjusted move and they report after earnings and you don't get the movement, right? The contracts that have the closest date to expiration are going to start to lose a massive amount of value really, really fast. And you may not get time to recover based on where that contract expires. So if they report on Thursday and then you come out Friday morning and you don't get the movement and your contract expires on Friday, what's a wrap? Right? It's a wrap. So a lot of people, what they recommend is that you should always play the upside. So like you see that on 9/10, it opened. And I want to say maybe around, let's say 9:30, 10 o'clock, it was around 95.50, right? That would have been a good time to exit if on 9/8, you would have bought a, let's say, an $85 or $80 or $90 contract to expire at the end of the week. So you maybe bought a weekly, right? That would have been a good time to exit. If you didn't exit at that time, what did you see 9/10? It started to fall, started to sell off. Then it gapped up. But if you see that on 9/11, where it gapped up at, right, was lower than the highest point the day before. So you didn't even get the gap up to match where you at the highest point the day before. So this is what I'm saying. When the expected movement does not happen, it kills your premium because the expected movement correlates with the volatility forecast. So when that doesn't happen, it's going to kill your premium, especially on shorter term contracts, right? So let's get into the next example. You enter with implied volatility too high, however, you don't know it. So one of the things, I know a guy that makes a lot of money in the options market. He recommends that when you're looking at calls and puts, you always look for volatility around 50%. And he says, look for 50% and 60 to 90 days out on the contract. In his mind, if I can't get 50% and 60 to 90 days out, I don't want the contract. He doesn't do weeklies at all because his attitudes are too risky, right? He says you can make money on it, but he says over the course of time, you're going to lose more money than what you make. So looking at these contracts right here, you're seeing that these Apple calls for October 23rd, right, in the money and out of the money, they're around 50%, except the 90 to 95 are in the 60s, right? And it's really unusual is that the 105 is 48%, but the 110 is 52, but the 100 is 54. That's really weird how they set that. What you got to understand is that looking at these Apple calls, right, they're all around 50%. Now, if these Apple calls were around, let's say 80 or 90%, so let's say the 116, right, strike for October 23rd was around 80%. And I buy that 116, but it's 112, right? So I buy on Monday, which is going to be what, the 13th, I believe, right? I buy the 116 Apple contract, it's a call contract to expire on October 23rd. We're at 112, right? I'm going to need a lot of momentum between now and October 23rd to increase the premium on that contract, right? Because of the volatility, the move of it is already baked into the contract. So listen to what I'm telling you, because this is a term that a lot of people use in the market and it's overused. The move, if the volatility is 80 or 90%, that movement is already expected. So because it's already expected, right, my break even, right, may be past my strike price. That's why I always recommend, always try to exit $1 or $2 in the money, right? Always look to exit, always buy a contract and you're looking to exit $1 or $2 in the money if you're trying to get profit. Because of the volatility forecast, and you can a lot of times based on your brokerage account, you can see what the break even is for each particular contract. But a lot of times just based on the volatility forecast, right, your break even can be past your strike price because of volatility. So this is what people got to understand. If you buy that contract and it's a higher volatility, you got to start seeing a lot of momentum in that amount of time to increase that contract. To where if you had a 115 or 116 that expired October 23rd, 2021, because we would assume that Apple's going to be way over 116 by October 23rd, 2021, right? You don't have to worry about that momentum movement because what? You got so much expiration on the contract. That's why a lot of people recommend 60 to 90 days because it gives you more time. So you're going to pay more for premium, but you got more time to get the move. Well, a lot of people like to buy weeklies because they're less expensive, but you got to get a lot of rapid movement with a weekly. With a weekly, you got to get a lot of momentum behind the play, right? Which is why a lot of people recommend don't buy weeklies. But, you know, you do what you want to do because it's your account. You're an adult. You can make decisions for yourself. Let's go ahead and get into the next one. So one, you never understood how to view implied volatility like a market maker. So this will be going back to the market makers. Understand, the market makers are not your friend, right? They create markets so they can make money, right? You have to learn how to make money in their market. The way you learn how to make money in their market is you have to understand how they think. Their job is to leave you holding the bag. That's their job. That's how they make money. You got to understand capitalism, right? Their job is to create something that you're going to buy and they're going to leave you holding the bag, right? Your job is to let somebody else hold the bag or give somebody else a contract that they can exercise at a strike price that they desire. So it's not always a negative thing because you could be selling a contract to somebody at a strike price in which they want to exercise the contract. Or you could be selling a contract to somebody that thinks that contract is going to continue to appreciate and they get left holding the bag, right? But that's not your concern because they bought what they wanted to buy at that time. Just like I live in the state of Florida, there is no limit law here. It don't mean that you look to sell somebody a bad car. What it does mean is that if somebody buys a car from you and 2 weeks later it go bad, they can't come back to you about anything. Why? Because there's no limit law. So you got to understand the game that you're playing, right? So a lot of people in the state of Florida that are looking to sell you used cars, they're not your friend if you don't know them personally. So you got to make sure you do things like get the car inspected, things of that nature. And I would never buy a car in the state of Florida if the person would not let me go get the car inspected before I buy it because I know there's not a limit law. So if I buy it and I get around the corner and it breaks down, once we execute the sale, I can't do anything about it. I can't take them to court because there's no limit law in the state of Florida. So you always got to understand the market that you're operating in, right? What you understand about options. When the implied volatility is high, and so we're using 50 as a baseline, but it doesn't mean that's a baseline for you. It means that we're just using this for an example. So we're calling 50 a volatility baseline, right? So we want our volatility to be around 50 or less if possible, right? If implied volatility is high, right, which I mean greater than 50, right, the seller makes money. Now, I want you to understand what that really means. You're buying the contract from a market maker. The implied volatility is, let's say 45 or 30, right? So you're able to buy it and enter the door at a lower premium, right? Market conditions change. There's a lot of momentum put behind that particular share price. It goes up. So you bought a call contract, right, with an implied volatility, okay, less than 50. So let's say 35, 40. That's what you bought it. Now I know that's going opposite against the greater or less than, but I want you to understand what I'm telling you. You bought a contract from the market maker. Implied volatility is, let's say, 40. It's a call contract. You pay less to get in the door. And I'm using that term, get in the door. What I mean is that you're able to enter this situation at that price point, right? Momentum is put behind that share price. It goes up. The market maker resets volatility on that strike price. Volatility now goes up to 80%. So what do we know now? The volatility, right, is a forecast of the movement of the security, which is also used to set the price of that particular security. So now they reset the premiums. Premiums go higher. You now own the contract. You're the seller. So now you can go sell it for more money. On the flip side, when implied volatility is low, less than 50, we're going to use 50 as a baseline, right? The buyer always takes advantage. So that's what's the early example. You're looking at a contract, right? And you want to buy it and the implied volatility is 30. You're the buyer now. You're able to buy that at a lower premium. However, you don't get the share price movement that you desire. You're getting closer to expiration and you got a low volatility. So now what happens, right? You're able to take advantage, but the person that wants to buy the contract from you now, right? The buyer, because you got to sell it. So now once you buy the contract, you're not a seller. Who now takes advantage? The next buyer. I hope I didn't confuse that. So I want you to understand, when volatility is high, the seller makes money. But as soon as you buy the contract from the market maker, you're not a seller. So what do you need now to make money? High volatility, because you now own the contract. When implied volatility is low, right, the buyer takes advantage. So as soon as you now buy a contract from the market maker, implied volatility is low. What does that mean? The next buyer takes advantage. Now you got to understand, this is all predicated on share price movement. So volatility is high in a binary event, and you don't get the movement. What happens? You start to lose premium. You understand what I'm trying to tell you? So you got to understand what is going on in the market and how these market conditions are going to affect your volatility. But the most important thing is you got to understand, what situation are you entering? So let me give you a real quick example before we wrap this up. When coronavirus is getting ready to really hit America, I bought put contracts on Carnival Cruise Lines because Carnival Cruise Lines had not yet become the face of coronavirus infections. I knew that was going to happen in that area. So what I did was I went in and I bought a put contract on Carnival Cruise Lines. I want to say I bought it in March. I bought essentially maybe $3 or $4 a put, $3 or $4 out of the money. I paid a less than $200 for it. And I bought an expiration date that probably went out 4 months. Why was I able to do that? Because of volatility. They had not yet readjusted the volatility for that situation with Carnival Cruise Lines. During that week, the whole situation with Carnival Cruise Lines and the people on the ship out there in California testing positive, all that unfolded. So what did the market makers do? They went in there and reset all the volatility forecasts. I sold that contract for like $600. So I got almost a 500% return on that contract. I went back in to buy at that same strike price, right? So now that strike price was already in the money, but I wanted to buy that same strike price. And when I looked at that contract was too expensive for me at an expiration date going out to like July. So I end up buying that same strike price at an expiration date going out maybe 30 days, and I end up paying $300 for it. So I paid almost 250% more for a same strike price, but a shorter expiration date. Why? Because volatility had already spiked up, right? So what happened? Volatility went up. The seller made money. When volatility was low, the buyer, who was me, I took advantage. And then as volatility spiked up because the situation changed, what did I do? The seller made money. This is why I try to get you to understand. If you can forecast really well in the market, you have the ability or the opportunity to buy when volatility is low, right? Take advantage and then sell when volatility is high. That's why I say you got to really learn what's going on in the market. You can't play follow the leader, because when everybody runs over there, now the volatility is high. So what the market makers want to do is create a scenario where everybody moves in the same direction at the same time. Why? Because then they can spike volatility and people will pay money just to get in without understanding what? When volatility is high, the seller makes money, right? Then if you don't get the movement that you desire, what happens? We're going to go back to point one. What happens when you don't get the movement you desire? Expected movement doesn't happen, kills your premium. It happens on binary events, but it also happens on non-binary events, which we call expiration dates, right? Or horizontal movement kills the premium as you approach expiration date. So what do the market makers do? They create a scenario, right, in which everybody runs in. So what do they do now? They ramp up volatility, right? Then what happens? They pin the share price. When I say pin it, what I mean is that they use algorithms to make the share price trade within a really narrow channel. Then what happens is with your weekly, if you don't get out on Monday or Tuesday, they pin the stock price and you start to see a decay in your premiums because of theta decay. So you went in because of high volatility. You paid a lot of money to get in the door. What you expected was to get the movement that you desire without understanding that even if you get that movement, because you pay so much money in the door to come in the door, your profit is going to be a lot less. So let me give an example of what I mean. We say, hey, you can get into this situation now and pay me $100 and you can sell it for $500. So which means you make $400, right? Well, over the course of the week, everybody hears about that deal. So what I do, because I got so much demand for that deal is I start to raise the price from 100 to 200. So now at the end of the week, you can get in the door for 200, but still sell it for, I think I said 400 originally. So now you make 200 as opposed to what you'd have made if you would have sold it for 100. So what the market makers do is that they try to create a frenzy around a situation, knowing they can get everybody to come over there and buy contracts. But what happens is, because the volatility is so high, even if you get the movement that you desire, what you're going to be able to sell it for is going to be a lot less. Why? Because the only time the seller makes the most money when volatility is high, but you got to find somebody else to sell it to. If the volatility is too high and the premiums are too high, it diminishes the market for something, which is like why a lot of people don't buy in the money. When the volatility is low, the buyer has the ability to take the advantage. So you as an options trader want to try to figure out, how can I take advantage of situations that are likely to happen from a probability standpoint, but I'm not paying so much more money to get in the door. And that's what we talked about. Look for contracts, if you can, with volatilities around 50%, and you got 60 to 90 days to get out. But most people don't do that. And I'm not mad at you, because I buy weeklies and I buy contracts in which the volatility is not 50%. I do this all the time. But at the same time, if you can become very disciplined as a options trader and only take the trades that have the highest probability for you to be successful, you'll be trading less but making more. But that's the challenge, is the discipline, because you see all these opportunities in front of you, but what you start to realize over time is they're not all ideal. So we want to start as traders asking ourselves, what is the most ideal situation for us to be profitable? What's the ideal situation? So people that understand strategy at a deep level, they understand, put myself in the best position to be successful, right? And if I'm not, then just don't get involved in something. You understand what I'm trying to tell you? So that's the real work as an options trader, as opposed to trying to be in a lot of plays because we know we can make some money. What is the best scenario for us to be profitable based on the probability that we're looking for? And we understand that if we can enter in situations that are likely to happen based on our analysis and pay a low amount to get in the door, as everybody starts to run over there, right? It's going to start to ramp up volatility, which means now we can sell for a higher amount because we now have high volatility. So we're almost in the same position as the market maker, right? And so one of the things I want to recommend to you before we close out, if you want to start learning more about how market makers see volatility and how it really works, if you can get Thinkorswim and you can get their paper trade account, you can get Thinkorswim, get their paper trade account, and you can start to paper trade selling options. And once you start to see how by paper trading selling options, and I may create a totally separate video on this. Once you see that, you can start to understand how market makers set options prices based on what they think they can get out of the public for these prices. And then you may have a better scenario and a better understanding of what it looks like from the buyer side. Because a lot of times in situations, people got to see both sides of the situation to understand where they're at. So a lot of times they say if you want to understand the argument, you got to look at both sides of the argument, not just the side that you're on. And so I think for a lot of us, if we start looking at the option seller and how they see the options chain and how they see volatility and how they see delta and how they view premiums because they want to sell them to somebody, right? And what they're really looking to have you do is to either have you exercise a contract or just get stuck with the contract expiring worthless, because that's how they make their money, right? And you really understand that's what's motivating them, then you can be a lot more informed of what kind of contracts you want to buy. So I hope this video was really, really valuable to you, because I wanted to try to approach this from a direction that most people are talking about volatility. They're talking about it from a very technical standpoint. They're not talking about it from a practical and applied standpoint. So what I want to do is try to give you some context. So when you go into the market, you're looking for setups that are really beneficial to you. And I know that we want to make money. I know that we have desires that we want to use the options market as a vehicle to obtain. But if we can really be patient and wait for a situation that's going to be really, really beneficial to us, as opposed to just getting in everything because it looks hot, I think long term, it's going to allow us to have the success that we really desire, because the market's not going anywhere. This skill set is not going to be perishable over time. And the more you get involved in the market and the more experiences you have, the better you're going to get at it over time. If you got any questions, hit me up. If you want to learn more about the highest paid part-time job in the world options trading program, click the link in the description. This is David W. Williams, also known as Diamond Dave. I'll talk to you later. How are you doing? This is David W. Williams, also known as Diamond Dave, and we're going to go into the Peloton play. And this is just going to be another one of the capstone courses. So we did the walkthrough. We still got the Rite Aid play. Now we got the Peloton play. We'll probably add something a little bit later, probably maybe third or fourth quarter this year. Let's see how it goes. But we're going to just keep adding to this because I want to really show you how to really thoroughly look at a play, analyze it from a lot of different angles, come up with a bull and a bear case, and kind of understand whether or not it's a great opportunity for you to try to look at it with options, right? Or maybe just disregard it. Therefore, you can spend time researching something. It doesn't mean that you should play it just because you researched it. It means that you can research it and everything could be a green light except maybe the options chain. Okay, I see a lot of plays like that. Or you can research it and you may feel like, well, you know what, there's still some uncertainty based on the direction of the play. And if I'm looking to play this from a long-term standpoint, that's going to be a lot less, I'm not as certain, but maybe I may try to do a shorter term play or vice versa. You may like it, not like it short term or like it long term. It all depends on the play. But what I'm going to kind of really show you is that how I was able to analyze this particular play. And I looked at Peloton for pretty much, I want to say the middle part of 2020, right after the pandemic started. And anybody that was following me on social media, but especially on Facebook knows that I was looking at this play because I kept speaking about it. I spent a lot of time observing this company. And one of the things I really want to get you to understand is that you have to be successful in this market, you really got to dedicate yourself to the study and the analyzing of a situation. Traders are really good analyzers, right? They just don't trade. It's not just about the computer. It's not just about the technical analysis, in my opinion. It's not just about what button you click on the program, right? And then eventually we're going to get computers to do all that anyway. I tell people what's going to differentiate you in this market is your ability to understand the situation. Your brain is what's going to make you different because everything else is going to get automated out anyway. Therefore, your ability to look at a scenario and be able to analyze it is where you're going to really set yourself apart from the pack. And so I would encourage you to keep working through a process of analyzing it as long as it takes you, and to continue to develop your critical thinking ability, not based on what somebody else tells you, but what you believe the information that is being presented, your interpretation of the information, not I don't want to do the work, so I'm going to ask somebody else what this information means. Then therefore, you're depending on their ability to analyze as opposed to yours. Now, you can get to that level where you got a team of analysts. However, as of right now, I want you to really develop your skills because even if you get to a level where you have a team of analysts, you need to have your own understanding so you can kind of determine whether or not they're telling you something that makes sense to you. Let's go ahead and get into it. Now, what we're looking at is the particular options contracts, and we're looking at the result of the play. So we see that this particular put contract was bought on July 15th, Thursday of 2021, and it was sold on November 11th, 2021. So we came in at 11:45 and we came out at 5:30. So that's a 340% ROI. Now, in retrospect, I should have put more on this play. And I'm learning now to focus on a lot the easier plays as opposed to the plays that are really complicated. That's something I talked about before. This was an easy play because I had studied this company for so long. I was very confident of where this was going to go, not based on me forecasting, not really based on me guessing, because of where they were going as a business and me understanding what people are buying when you're investing in a company. And we're going to kind of go into that. So this could have been I should have made this into a $15,000 return, right? With a maybe $3,500 investment. But like I said, as I was kind of scattered when I did this, and I'm learning not to be that way. And I'm learning to plays that I have a really, really high conviction on, that I've spent a lot of time analyzing, that are easy plays. Because one thing about this particular contract, the options chain was very, very liquid. This company does a lot of volume on the daily, does a few million on the daily. The options chain was very liquid. This was a very easy play. There was not a cult behind this particular ticker. There was a lot of green lights in which I probably should have put more money, but you live and learn as you trade longer, you spend more time in the market, you get better and better at understanding what's going on. Let's get into what we're going to talk about. So the goal of this module is to help you understand how to fundamentally analyze a company and potentially play with options contracts. The key word is potentially. Doesn't mean that you do it. Many of us will feel like, you know what? I've spent, 10 hours studying this company. I've spent the last 3 months or 6 months looking at it. That justifies me doing something. No, it doesn't. Just like if you're going to invest in a company long term, you may spend, 50 hours looking at a company. Just because you spent the 50 hours don't mean you buy the stock. It just means that you have a better understanding of that company. You may buy later. Doesn't mean that you have to buy right now. And you going through a process of understanding how to analyze only makes you better at it. Why? Because this is what you're going to continue to have to do. And this is what a lot of people don't understand. A lot of people are still looking for the quick result in something. And that's the problem, is that instead of investing in the skill set, investing in the process to get good at it, to get the result, I need a quick result. We talked about before. I watched this company literally for over a year because I started watching it right after the pandemic. So let's go back to the last slide. I started watching this company right after the pandemic. I did not buy this put contract until over a year later, July 15th, 2021. I started watching this company, I want to say maybe in April or May. So pretty much almost a year before I bought this contract. And I just kept observing it, and I kept observing it, and I kept observing it, because I was very confident of what I was looking at, and had a lot to do with a lot of different reasons. So what we're going to talk about is, what is the Peloton business model? We're going to talk about what happened pre-2020. We're going to talk about what happened in 2020. We're going to talk about why I was bearish on Peloton long term. We're going to also go into the bull case, because you need both. And then we're going to go into like a conclusion, right? And what I want to show you is the chart. Now, this is the chart of Peloton. This is the chart from their IPO to where we're currently at now. And we're in December of 2021. And we're looking at the chart. They're almost at their IPO price. And so what it took was around 3 years for them to get almost back to their IPO price. We see them come out, and we see around the pandemic, mid to late 2020, we see a slight sell-off. They get under the IPO price. And then we see them really come out of that hole really, really hard. We see them get to around 125. They sold back down to around 100. They went back up to 150. They traded sideways a little bit. They went all the way back down, sold back down off to 100, got back up to 125 again, right? Got back up to 125, and then sold all the way back down to 38.50. And so you really want to understand that this chart started breaking down under 150. We started seeing a lot of price rejection under 150. And there's a reason for that. It's not just something that's happening randomly. When they got around 150, we're starting to see a lot of price rejection at that particular price point. But they came out from, I want to say, around $20-something around April of 2020. And literally by the end of that year, they were already at 150. And they started getting rejected at that price. They got rejected all the way down to around 100. People bought into it. They got to 125, and they got rejected back down again. So what the market is telling us is that it didn't want it at 150. Then based on market conditions, it didn't want it at 125. And then we're seeing big sell-off on the weekly candles. Okay, so I want people to really understand this. So now what we're going to start doing is we're going to kind of go into the pieces of this particular company. But this is the kind of work that I want to really encourage you to do. Now, what did I do? I really identified first on the chart where the resistance was at. Okay, and many people kind of overlook that. So they'll be bullish or bearish on a company, and they may not have identified support and resistance points. So looking at this chart off the top, where am I? I'm not seeing a lot of support, and that's one of the things that you see with a lot of these pandemic plays. They ran up so fast, there is no support. So the problem is when they start to sell down, there is no price point to where you start seeing a lot of consistent demand or what we call a lot of consolidation of price. What we're seeing with this particular ticker is that because of the market, they ran up really, really hard to 125. Okay. You don't see any really price consolidation until around 150. Then you see a little bit of price consolidation in a range between 100 and maybe 125. And then when the market decided that, you know what, it's still overpriced, it started to sell down really hard off that 100. You understand me? So you want to sometimes identify this, especially as a swing trader. Where is your support and resistance? And we talked about this in earlier modules, right? Because what we're seeing is supply and demand. Okay. And we're going to kind of talk about that because this company has had several dilution events where they issued out more shares, which means what?
They increase the supply of shares. That has a lot to sometimes do with the price selling off. Okay, but I want you to really understand that. So now what we're going to kind of do is go into more of the business model, some of the technicals. When I say technicals, I mean the financial stuff, things of that particular nature. All right, let's get into it. Let's look at the Peloton business model. Now, Peloton presents themselves as a fitness company, but in reality, what they really were to me, and something that the CEO talked about, was a media platform. And to me, when I looked at what they were selling, their model was to get you to buy the front end content. To get you to buy the front end product, then to drive you into the media platform, which was a subscription-based revenue. And so you bought a product up front that got you into like the Peloton universe, and then you paid a subscription to get their media content where they had their classes, and then they continue to get that subscription revenue out of time. So they get the upfront money on the product, but their lifetime value of the customer comes from you staying in the subscription plan. So what we're looking at is, what is the average order value? Then what is the lifetime value, right? Because we understand that is what we're going to use to determine what we can pay from a marketing standpoint to get customers. Then also you got to look at what's the attrition rate. So if we bring somebody into this particular universe and they're paying monthly, how long do we keep them? Because that also impacts how much we can pay to acquire them. So when you're looking at a business that's constructed this way, what you want to look at is what is the average order value? What do I mean by that? When a person comes into the business, on average, what do they spend? Then what you also want to look at is that if we have a subscription model, which increases revenue from that particular customer, once they come in and we bring them into the subscription model, how long do they stay? Because those numbers determine how much we can pay from a marketing standpoint to get the customer. Why is that case? Because if I understand that, you know what, I'm bringing somebody into this business, but they're only staying 3 months. I can only spend so much money to acquire them using a marketing cost than if I was bringing them into the business and they're staying 2 years, because I have a long, what we call back end, or also lifetime value. These are the things that you want to understand when you're looking at these type of companies. Okay. Also, when you're looking at the fitness space, fitness is seasonal. What do we mean by that? If we look at most fitness companies, but also most diet companies like Weight Watchers, they normally drive a lot of revenue a certain time of the year. This is historical. Okay. And I would encourage you to look this up. They normally drive a lot of revenue a certain time of the year where people become more fitness oriented. And then also certain times of the year where people are less fitness oriented, that revenue normally drops off. Therefore, when I'm looking at Peloton, until they prove me different, I'm going to believe they're going to operate on that same type of fitness trend. Also, most fitness trends, right, are here today, gone tomorrow. What do I mean by that? You create a fitness offer, it does really well. A lot of people run to it, they get tired of it, they go do something different. So one thing about the fitness space is people are constantly reinventing their offers. They're constantly trying to refresh their offers. Why? Because you're dealing with the average fitness consumer. The reason why they're in the market is because they're not successful. One of the reasons why they're not successful is because they're not consistent. Therefore, they'll buy your product because it's the hot thing now, and in 6 months, they'll go do something different. That's just how fitness works. This is before Peloton. So the only way Peloton can get out of some of these paradigms is to have something so revolutionary, something so transformative that they change the habit of the customer, because Peloton is going after the average fitness customer. Peloton is not going after elite athletes. That's not where the scale is at. The scale is going after the average fitness customer that is really unsuccessful. So we got to add this into how these things are going to impact their model. Now let's go into what their model looks like on paper. At this particular time, right? What's the date on this real quick? So this particular time, this is July 5th, 2021. How does Peloton make money? Peloton is based on 3 streams of income. That's the connected fitness products, the apparel, and the subscription revenue. So let me bring this up, make this text a little bit bigger. So fitness products, connected fitness products, apparel, subscription revenue. Okay. So the first one is going to be the Peloton bike. That starting price is $2,200 with an option of monthly payments at $58 a month. So they're making it easier for you if you take it on a payment plan. Okay, so that's a high ticket fitness offer, because to get into it with the bike, you got to pay $2,000. Now we got the Peloton tread, right? That's at $4,000, right? So these numbers are going to come into play later on in this discussion. So what Peloton is doing is they're really going after a segment of the market that has the money to pay this, or is willing to sink into a monthly payment plan of $58 a month, right? And I'm not sure they have that for the tread, but they got that for the bike. So that's $4,000 for the bike. And so if you look at their S1 right before, I think they IPO'd, 78% of their revenue comes from those two products, right? And then they said that they doubling revenues from in 2017, 183 million to 348 in 2018 to 719 in 2019. So their revenues was going up per year in these years before the pandemic. And we're going to kind of talk about that, right? So what happened pre-2020? And then they was getting at a margin around 43% for a physical product, which is a really good margin for a physical product that you got to get manufactured, you got to get shipped, yada, yada, yada. So one of the reasons why a lot of people were bullish on this company and what the bull case was their margins on the product. We're able to sell this high ticket, right, product to this consumer, get 43%, which is almost half of the cost of it, comes back to us as profit. And then we're also able to sync them into a subscription plan, right? And get more recurring revenue or subscription-based revenue out of this, even though we already on the front end got 43% of this high ticket product in the fitness lane. Now we also got the apparel, but the apparel accounts for less than 1%. So they were trying to build out their apparel line, right? And then we also got the subscription-based services, which to me was the real business. In my opinion, the real business was not the products. The real business was the subscription service, because that's where the long-term revenue is at. And kind of based on the value and also based on where it's priced, a lot of people is not going to, they're looking at a customer that paid $2,000 up front to get into this particular deal. I don't think they're going to have an issue with the $39 a month. So what you can get with this kind of customer, if you continue to give them value, build community, is you can get a customer that stays in that $39 a month price for years, right? So let's take that 39 multiplied by 12. That's 468. So 468 times 3, 468. Let me bring that back again. We'll take the 468 times 4. That's 1872. So really it's going to take about 5 years at that $39 a month to pretty much equal what you would get from the bike. This is why that bike purchase or that treadmill purchase of almost $4,000 up front was such a good deal, because we get a lot of revenue from this customer on the front end. The question is, and the question I always had, is how many customers are there to buy a bike at $2,000, right? Which is pretty much almost, I want to say what, 4 years or 5 years at $39 a month at $2,000, and then definitely to buy a treadmill for $4,000. How many people exist in the marketplace to get them ready to buy at that price point, right? And do we have the marketing to continue to persuade and influence people that there's so much value being offered, right? We're such a different company as Peloton that we can continue to deal with this. Because the first thing I'm looking at when I'm looking at these prices is I'm thinking demand wall. I'm thinking once we essentially sell this to everybody that's willing to buy at this price, now what are we going to sell them? Because if we want to expand this company, we got to have something else to sell them. Or we got to create a different category based on price point to go after a different market. And we're going to kind of go into this later in this discussion. But these are the things that are jumping out on the onset, right? I got a fitness-based company, which I know a lot of times fitness is one seasonal. It's also here today, gone tomorrow, trend-based. They're selling a high-ticket product on the front end, which is it's really a good thing because we're getting a 43% margin. The problem is if we hit a demand wall, like once everybody buys the bike or everybody buys the treadmill that's going to buy it, how do we continue to expand into different markets? Because we're at these price points, even with having the ability to do monthly payments. That's a long time to pay for that bike at $58 a month with a $2,000 bike. You understand me? These are the kind of things that you want to think about. So this is their business model. It's physical product, it's merch, which is less than 1% at the time that they launched it, and which probably never was going to be big for them compared to because the cost of the merch, and then also the subscription model. So the merch is probably going to always lag because one, it's a one-time purchase, or the merch is not a subscription purchase, and also it's not high ticket. And that's really what I want you to understand. So that's the business model. Now we're going to kind of go into some other parts of this particular discussion. also known as Diamond Dave, the founder of the highest paid part-time jobs on the World Options Training Academy. Let's do this really quick technical analysis breakdown of Royal Caribbean, and I'm gonna kind of show you what I'm looking at and what I would encourage people to look at if they kind of wanted to understand where the price action was taking this particular stock price. And what we're seeing is that Royal Caribbean and a lot of the other cruise lines, also a lot of the airlines, were dealing with some selling pressure because of the high price of oil. So oil has really spiked up. Futures contracts have spiked up. And as a result, people are less optimistic about the future of these particular operations. And one of the reasons is because they use fuel or gas to operate their ships. And if the cost of gas is going to be more expensive, especially as we go into the future, it's going to really put a lot of stress on their revenues, because then what they're going to probably have to do is turn that cost over to the customer, or they're going to have to eat the cost, one of the two, which could put a lot of stress on their balance sheet, which could put a lot of stress on their ability to return equity back to their stockholders. And this could be something that may be long term. So there's a lot of uncertainty and a lot of anxiety in the market. And what I want to show you is that I have put contracts on Royal Caribbean. However, if you're trading this, there's a way in which I would look at it. And I'm going to just show you how I would look at it. And then you can take something from it. You can implement it to your program, or, you know, it might not be any benefit to you. But I want to kind of show you how I would look at it, because what a lot of people, when they're looking at technical analysis, they're looking for something that's going to be very specific. And a lot of times what you're looking for is ranges. And I think they don't understand that. And because they don't really truly understand technical analysis. And when you really understand it, you're not always looking for a specific number. People say, well, where's your entry at? Well, my entry on options contracts is going to always be at the money or in the money, unless there's an extenuating circumstance. And I would only recommend that to experienced traders. If you're a novice trader, which means you've been trading under a year, I would always encourage you to trade in the money or at the money. That's not investment advice. That's just what I did, and that's what allowed me to become successful. So what I'm looking at really quickly, I'm going to show you, is I'm looking at Royal Caribbean on the yearly chart, and I'm going to show you where I'm seeing the support at. So let me go ahead and draw a line here. I don't want the purple. Let's try this yellow. And do I want a line? Is that going to give me what I want? No, I don't want that. That's going to be undo. Let me get something else. Let me get a horizontal line. Okay, so let me show you what I'm looking for. Let me get my line up. What I'm looking for is around, let's say, the mid to high 60s is where I'm seeing support. And so what I'm seeing is, as I zoom in more, is we get here and we're starting to get buyers come back in. They believe that the price is cheap. We get around here and buyers start to come back in because they believe the price is cheap. They start moving the price back up. We get here again and we see that buyers believe that the price is cheap and they start to move the price back up. So what I'm looking at is like in the mid to high 60s, low 70s, people start to believe that Royal Caribbean is inexpensive. They like that price of the stock and they start to come back in to buy it up. That's on the daily candles on the yearly chart. So when I'm looking at it this morning, right, we come out of the market. So let me go to the 1 day. We come out. What I'm looking for is, do we start getting buyers around this price? Let me zoom back in. So we're looking at the 1 minute candles. So we're under the support, but I'm looking at, do buyers start to come back in, right, around the mid to high 60s. So what we started getting was some early, right, buying on the 1 minute candles, right? Then that fatigued and it dropped back under that last support on the 1 minute candles on the daily. So what I'm seeing is that people still believe that the price now is high at those points. So going back to the yearly, what we're seeing that is that we're now under the support, right? Let me zoom back out. We're under that support now. Now we've been there before because we've been there here. We've also been there here. However, if we start getting to around $60, right, we're looking for our next support to be maybe in the 50s. So we get under 60, we're looking for our next support to maybe be around the $49, $50 mark. Okay. And so that's what I want people to understand, is that when you're looking at a particular ticker, I historically try to find out over the yearly, where did the buyers start to come in at? Where do what called a supply zone? And normally people look at a supply zone, you know, where you got the red bars, you got to get the next so many consecutive bars, got to be green after that last red bar. I don't necessarily do it that way. My attitude is that on the yearly, where do I see buyers start coming in at? Okay. And this is the yearly on the daily. Now we can change this and go to the weekly, right? Go to the weekly and you see something similar where we see the buyers start to come in here. We see the buyers start to come in here. We see the buyers start to come in here, right? So now what we want to continue to observe, because on the weekly we can get a change because it could trade red today and tomorrow, and then the rest of the week pick back up because, like I said, maybe the oil price starts to rebound back. However, I'm always trying to figure out historically, where do I see the buyers start to come in at? And then my thing is that it has to be something that's going to be extenuating or outside of those normal conditions to make people want to keep selling this down. Because what we saw before and what we saw was that around the mid 60s, low 70s, buyers start to come in. So we go back to the daily. What we want to see is that we just get continuation of the sell-off, right? Do we get continuation of the sell-off? So we get higher highs and lower lows. So we're seeing on the 1 minute, they're starting to print at the 65.22. Do we continue to get another sell-off? That we can go to, let's say, the 15-minute candles, right? On the 15 minutes, do we just keep getting lower prints as we go down? Because if we go to the 5-day, this is the 5-day. So what we get is we just keep laddering down. And now, why is this the reason? Because gas prices are high. So now you can trade this purely technical, but that's not what I normally do. Because I don't want to be looking at, well, you know, is there a green candle after the red candle and I need to get this subsequently green? I don't even understand how to do any of that. I have a fundamental analysis based on what's going on from a macroeconomic standpoint, which we know what is going on from a macroeconomic standpoint. Then how is that impacting the overall sector and the industry? And how is that impacting that individual company? And does the company management have any kind of solution to the problem? Royal Caribbean has not come out and said, well, this is how we're going to deal with this high cost of gas. Nobody has said anything. I don't think you can do anything about it. Like everybody else, you just got to pay it. Therefore, we understand how this can impact, right, their future revenues, especially if this gas price stays elevated, even though I don't think the gas price is going to stay elevated, right? I think it's going to top out and then it's going to dump really, really hard because we can't operate with gas prices being this high for a consistent period of time. I don't think this economy can take it. Okay, so want to give everybody a heads up on that. If you got any questions, hit me up in the comments. This is David W. Williams, also known as Diamond Dave. I'll talk to you later.